Mr. Speaker said, was the period associated with the economic meltdown years leading up to 2008. So for 11 years, between 1997 and 2008, pensioners lost values. We know, Mr. Speaker said, that from the Justice Smith Commission of Inquiry report, which was tabled before this August House in March of 2017, that 5.68 billion US dollars worth of pensions was lost as a result of three main factors that were identified in the Justice Commission report. The first one, Mr. Speaker, which caused loss of value, was the macroeconomic environment, or rather the mismanagement of the economy, manifested primarily through the hyperinflation that we experienced during those years. So you could say, Mr. Speaker, that the macroeconomic environment is a baby of the government, and the Justice Smith Commission of Inquiry placed 46% of the blame of the loss of values on government, 46% of the blame. The second cause was the behavior, the predatory behavior of insurance companies and insurance houses. And the Justice Smith Commission report placed 22% blame on insurance companies. And two insurance companies were singled out for terrible behavior. One was the Old Mutual, and the second one was the First Mutual. Then the 12 or 14% blame was passed on to the regulator, IPEC, the Insurance Pension Commission, that we're debating today. So 46%, 22%, and 12%, that was the breakdown of the loss. With that background, Mr. Speaker, the government has gazetted 3 bills that are dealing with the insurance sector. The first one, which we are debating today, are amendments to the Insurance and Pension Commission bill, which is the one which we are debating today. The second one, which we'll be debating perhaps this week, will be a new insurance bill. The third one, which was gazetted, they were all gazetted on the same date in September, is amendments to the Pensions and Provident Bill. Now, the challenge with all these 3 amendments, Mr. Speaker, is that they don't address the causes of the loss of value to pensioners and insured persons that was identified in the Justice Smith Commission of Inquiry report. So I agree with the Honorable Lisco that we need to go back to the drawing board, but for different reasons. My different reasons being that the 3 bills that the government has presented in response to the Justice Commission bill, namely amendments to the Insurance Pension Commission Act, the regulator, amendments a brand new insurance law, and amendments to the Pensions and Provident Bill don't attack the government, the cause of the pension crisis which we have in this country. And Mr. Speaker said, we need a second commission of inquiry. The Justice Smith Commission of Inquiry dealt with loss of value up to 2008 and the conversion of assets by insurance houses in or around March 2009. But we have a second loss after 2009, Mr. Speaker said. Workers regrouped, employers regrouped and started making contributions in US dollars. But after the passage of SI 33 of 2019, insurance houses, in particular the same old culprits, Old Mutual, First Mutual Life, they are now paying out benefits in RTGS dollars. Yet contributions from 2009 to to February 2019 were being paid in US dollars. Now, I have no idea of the loss of value between 2009 and 2019, but my rough calculations put it around 3 billion. So if you add 3 billion to 5.68 billion US dollars, it means pensioners have lost close to 9 billion US dollars in a space of 8 years. Mr. Speaker, that is not good enough. Because the pensioner is my grandfather. The pensioner is my father. The pensioner is myself. The pensioner is you, Mr. Speaker. So we can't afford an economy to lose pension value. And one of the reasons, Mr. Speaker, why we can't afford to lose pension values, pensions represent forced savings. And all over the world, the biggest asset holders are pension houses. They hold huge amounts of money in their banks, which other people borrow to kickstart the economy. So when you don't have pensions, it also means that you don't have savings. And a normal, decent country requires at least savings, which are at least 25% of GDP to have a sustained GDP growth. China, which is now the second largest economy in the world, has savings ratio to GDP of 50%. That is why we can't mess around with pensions. And that is why, with great respect, we need to go back to the drawing board, both as the executive and as the committee, so that we consult citizens. I heard the chairman, my good friend, the chairman of the Budget and Finance Committee, saying we consulted the pension houses, the insurance companies, but they're culprits. Let's consult trade unions, let's consult workers, let's consult employers too, because employers also lost. So I don't think, Mr. Speaker, there was adequate consultation to register insurance houses. And I'm using the word insurance house in the broad spectrum of all the companies that they are allowed and all the sectors that they are allowed to supervise. Mr. Speaker, once you are given the role and the responsibility of registration, it means you are creating. You can't create and then regulate your own bank. It is the problem which we are having in the banking sector. The Reserve Bank registers banks in terms of the Banking Act and then supervises itself. In the past, Mr. Speaker, there was a registrar of banks housed in the Ministry of Finance, physically used to be called Mr. Chinarans. I think it's still there. Then you have the Reserve Bank as the regulator. I submit, Mr. Speaker, there must be a registrar of insurance and pension funds who is not IPAC. Because you can't regulate your own bank, you can't regulate your own project. So I submit that that is a fundamental weakness, the starting fundamental weakness of this bill. The second fundamental weakness is that board members of IPAC are also insurance players. Some of them are own insurance houses. Some of them are employees of insurance houses. I submit, Mr. Speaker, that this incest must be done away with. If you work for an insurance company, if you own an insurance company, you can't sit on the board of IPAC. You can't regulate yourself. So if you look at the current board as it exists, you actually find that there are some actors who are actually running insurance companies. So I would like to see a situation with great respect, Mr. Speaker, that there's a total proscription, a total and absolute proscription of board members who are also players, because you can't be a referee and a player at the same time. The third aspect, which was also touched by the committee, is the vague definition of assets in the bill. And I think that was deliberate. Part of the problem, Mr. Speaker, said with these insurance houses is that they hedge insurance losses and insurance values through assets. They buy assets, buildings, and so forth. Then they create separate companies that will own the assets that will be created. So if you look at First Mutual Life, I think there's a company called Zanu-PF or something that actually owns buildings. So the companies are now dealing, the assets are now dealing Yet the assets are insurance assets because they were bought from proceeds of pensions and pension contributions. But IPEC, the regulator, cannot regulate the new company that has been created, that is owning buildings and that is owning shares on the Zimbabwe Stock Exchange. In my submission, Mr. Speaker, the regulator must regulate anything owned and created from insurance assets and insurance values. Two, the aspect of creating shelf companies that then own assets like land. If you look at ZP, if you look at First Mutual Life, if you look at the Old Mutual, that should not happen without the approval of IPEC. But IPEC should continue regulating those assets because they are essentially insurance assets. So I support the committee that there must be a clearer definition of assets so that we cover everything. Because these people hide everything in different companies. This was confirmed by the Justice Smith Commission report. Fourth, Mr. Speaker, the biggest insurance house in Zimbabwe is NASA. It's the biggest, collects over $40 million US a month. But it's not regulated by anyone. The Minister of Labor and Social Service, my good friend Professor Maviva, cannot be a regulator. Equally, the Minister of Health, the esteemed Vice President of the country, cannot regulate medical aid schemes. So it's a lacuna, it's a serious omission that NASA is not regulated by IPEC. And I submit, Mr. Speaker, that NASA should be regulated by IPEC. And NASA, Mr. Speaker, is one of those notorious companies that whose asset base, other than contribution, is now bigger than the contributions. And the board of NASA now has now forgotten the core business of NASA, which is to look after workers. They are now looking after the profits and the companies and the shares that they are busy acquiring on the Zimbabwe Stock Exchange and in the economy. So the issue of regulation, the issue of IPEC having regulatory insight and oversight over NASA is very important. The next issue, Mr. Speaker, is the creation of the funds. The Act creates a policyholder fund. Now, on the face of it, that is a good thing. On the face of it, that is a good thing. But you read the small print and you will see the problem. This fund is only protecting policyholders against one omission, which is the insolvency of the company. But if you look, Mr. Speaker, the challenges that have caused pensioners to earn 60 RTGS has nothing to do with the collapse of pension houses. The Old Mutual is there. We found it there, we're going to leave it there because it's a colonial, a company representing white monopoly capital. So the mischief is not the closure and the insolvency. The mischief are those factors which were identified in the Justice Smith report, which was number one, the macroeconomic environment and hyperinflation. Number two, the greediness and predatory behavior of insurance companies. Number three, the lack of proper supervision by IPEC. Therefore,